Please welcome our speakers, Matt Dickerson, Director of the Grover and Herman Center for the Federal Budget, and Norbert Michel, Director of the Center for Data Analysis. We hope you enjoy the program.
Morning, and thank you for joining us today. It's my pleasure to welcome you to the event, Inflation and Congress's role in controlling it. And today I'm joined by Matt Dickerson. He's the director of our Grover Herman Center for the Federal Budget. And the purpose of our conversation today is to get as many facts to you as quickly as possible about inflation and Congress's role in controlling it. So I'm delighted to dive right into that conversation. And we're going to start at the basic point. Matt, let's just talk about what exactly is inflation.
Sure thing. When we talk about inflation, as a general matter, what we're talking about is the overall level change in the level of prices throughout the entire economy. And I would contrast that with what some people might perceive inflation as being, as the change of individual goods or services.
And so what we know too from the data in the last few months is that individual prices of certain categories of goods have gone way up. And that sort of sparked some of these fears about inflation. But what we're saying here, if I'm reading you right, is that that's actually not necessarily inflation.
Absolutely. When the prices of a certain good or a service is going up or down, that isn't necessarily per se inflation or deflation. Prices in the economy go up and down all the time. Often that's based on the normal mechanics of the market, the supply and demand, not necessarily the change in the overall price level. I think one thing as a good example is gas prices. Right, through a normal year, gas prices will often fluctuate about 20% based on driving patterns and other government regulations that restrict supply and demand. As an example, a year ago, demand for gas fell pretty dramatically over what a normal summer months would be, as the government restrictions on travel depressed demand for gas. But earlier this year, there was a pretty significant restriction in supply of gasoline with the pipeline cyber attack that dramatically reduced the amount of supply, and we saw prices go up from there. But that's not necessarily indicative of the overall level of price changes for the entire economy, for the change in just that one good. But I think it's helpful now that we talked a little bit about the kind of the baseline generic, what is inflation? Obviously, we're doing this event here for a reason now, and that's because the most recent inflation reports, the CPI reports from the Bureau of Labor and Statistics, made some news over the last couple of reports. So I was hoping you could dive in and tell us what those reports said.
Sure. So the April report showed month-to-month changes in the consumer price index, the CPI, of about a 0.8% increase. And then in May, we had about a 0.6% increase. So it didn't go up quite as much, but it still went up quite a bit compared to what had been happening. And then the numbers that really got people sort of up in arms were the annual changes. So if you look from April to April 2020 to April 2021, you had a 4.2% jump in the CPI. And then if you do the same thing for May, from May to May, it was a little bit more than a 5% jump. And those were some of the biggest increases that we've had since around 2008, when we had another big shock. So that should sort of so that just shows you sort of the issue, what sparked all of this concern, and also kind of gives you a context of okay, wait, let's take a breath, because the last time we had a really big shock to the economy, something similar to this happened. So it's not indicative necessarily of a long-term increase in inflation. That's something that we always have to worry about, but we still have to keep things in perspective and watch them. So that's kind of where we've been, or why we're here, and what's been going on just in these last couple of months coming out of the pandemic.
Sure. And maybe could you dive into some of the components that made up those year-to-year increases and what kind of drove those headline numbers?
Yes, that's one of the more interesting things too, I think. Again, talking about coming away from a shock. The shock that we've had this time isn't a financial crisis, but it was the COVID pandemic. And in some respects, it's even a little bit worse than the 2008 shock, because we literally shut businesses down and people had to stay home or felt they had to stay home and stop spending and stop going out and buying things. So there was a huge drop in demand, a forced drop in demand, and we saw a drop in a lot of different prices. And then as the economies opened back up, that demand goes up, people start going out and spending again. And they also have some extra money from some of the stimulus spending. So you would expect to see demand go up, and that's what we've seen. If we look closely, what we see is some of the COVID-related, is what I'm calling them, COVID-related categories of spending that explain a good portion of the jump. Used car and truck prices, for example. A lot of the major rental companies were completely lost, right? No business whatsoever, no traveling. So they sold off a lot of their fleet and a lot of their fleets of cars and trucks. And that's all changing now. That's coming back now. They're buying now. There's more buying. So you've seen a huge spike in those car and truck prices. That category by itself is about roughly 13 to 15% of the CPI increase. Wow. Yeah, that explains a good bit of it. Then when you look at things like food prices, whether it's restaurant meals or just whether it's dine-in, takeout, or just food, hotel lodging, airfares, these sorts of travel-related expenses, right? Which is, again, where you would expect to see a big drop. Those are starting to recover. So that's about another 12 to 15% of the overall CPI change in these last couple of months. Then when you throw in energy and gas prices, which we know spike around this time of year, you're looking at just gas prices is about a third. So when you combine all those things, that's about half of the jump. Now, that isn't necessarily good, but there is an explanation. There's a logical explanation there. It's not necessarily because of a new inflation spike. It's a recovery spike, right? Now, that could become a problem. That's something that we have to watch. But the Fed is watching that, and it has not gotten out of control yet. It is still something that is reasonably to be expected, or is to be reasonably expected.
Yeah.
That's where we are on that. It's COVID related, yeah. And it's going to take some time for that stuff to shake out. So I think it's also worth mentioning there, when we talk about these COVID related problems, these also sort of caused some labor issues, right? And that's also a concern. I think that's potentially and partially now responsible for some of the prices. Restaurants in particular have a really hard time hiring people and getting people to come into work. They have to advertise that they're going to pay you more if you're going to come to work there. So that some of that cost is almost certainly getting passed on to the consumer. Maybe that's temporary, but it's certainly getting passed on, so that's part of it. And everybody's not back to work yet. That drives another sort of concern that we hear a lot now, which is, hey, are we back in the 1970s? Are we at this stagflation thing of the 70s?
Yeah, I would say that we're not in the 1970s stagflation era at this point, right? If you look at the labor markets, which you mentioned and highlighted, obviously the level of unemployment is too high. It's well elevated above the pre-pandemic levels, and a lot of that is driven by government policy. Obviously, we've seen the unemployment bonuses where we're paying people $600 extra per week on top of normal unemployment payments, and that's driving a lot of people out of the labor market. We've seen actually more people receiving unemployment benefits than are considered unemployed by the BLS surveys. But if you still look at the 1970s era, during the Jimmy Carter years, the unemployment level there was still higher than it is today. And if you look at
it's a different cause, right? I mean,
yeah.
These are completely different scenarios,
exactly. Right? And if you look at the level of prices in the 1970s, we're still not in the same neck of the woods there. the lowest annual increase in the consumer price index in the 1970s was above 3%, the lowest level. And we haven't matched that on an annual basis yet for a calendar year. And we saw inflation rates as high as above 12% in 1979 on an annualized basis. And the average annual increase on a calendar year basis in the 1970s was over 7%. Whereas in contrast, over the last 20 years, we've been averaging annual inflation under 2%. The Federal Reserve has been undershooting its 2% target, right?
Yeah.
The
They've
average
had trouble meeting the target, right?
exactly
Everywhere.
the average monthly change in the CPI in the 1970s was 0.63%, whereas over the last decade, the average monthly increase in the CPI has been just 0.14%. So obviously, things can change quickly, and we should be monitoring the data, but I don't think it's time to overreact necessarily at this point. But like we said, things can change quickly. The CPI levels have increased over the recent months, and there's certainly a risk of higher inflation, potentially through all the big spending that's being proposed. So Norbert, I was hoping you could dive in to some of the risks over the potential of additional stimulus spending and what that could do for inflation.
Sure. Even, and this isn't, I'll quickly interject, this is not a partisan issue in the sense, even Larry Summers, who is on the left solidly, has come out and said, okay, wait a minute, the stimulus guys, the stimulus packages that you guys are putting out here, this is much bigger than the demand shortfall. Well, that's a classic problem, right? That's a classic inflation problem. So yeah, that risk is real. In some sense, you get too many dollars chasing too few goods. We get a whole bunch of money out to a whole bunch of people, but we haven't done anything to change the underlying structure of the economy. So everybody has extra money to go spend on the same amount of goods. That is a recipe for inflation. So we do have to watch that. And I think that if you do it from the fiscal side, there's more of a danger probably of inflation. Because the Fed is closely monitoring inflation and trying to adjust the supply of money based on what they're seeing, whereas Congress is just trying to give people a bunch of money.
Yeah.
So, and then once inflation's up, way up, it's like, oh, okay, well, we're not going to do that again. Let the Fed clean it up.
Yeah.
Right, and it is too late. So there's definitely a danger, and I do think the danger is more on the fiscal side. I do think, however, we want to be careful because, and these are slightly different things in a way. But I think that one of the things that we've encountered is this narrative that, well, the Fed's been printing all this money, and that's going to cause inflation because that always causes inflation, and that's not quite right. And we have a graphic here to show that it's as a general principle, it's not quite right. If we look at when the graphic goes up, we'll see what we've got is a plot of changes in the money supply and changes in inflation in the price level. There we go. So you've got changes in the money supply in blue, and the inflation changes in red. And this is over the last decade. And what you can see is that we commonly have very large spikes in the blue line in the money supply, but there's no change in inflation. We could have even done this for 2 decades, but we made the graph look neater by shortening it to 1, and probably past the last 2 decades. But we do have an incredibly large spike recently, but still the point holds that you normally see spikes in the money supply without necessarily seeing changes in inflation. And the reason is that what we're leaving out when we talk about this idea right now is a change in the demand for money.
Okay.
Or you might even hear the term velocity of money.
Okay.
Same difference though, right? What we're talking about is people are just holding on to money and not spending it. So that is essentially the Fed's job, to respond to that and to make sure that there's more money in the economy. Otherwise, it's a calamitous. It's an even bigger, worse shock. So the data, it does show that the Fed has appropriately kept
Okay.
liquidity out in the economy to offset that drop in demand. And because of that, it's not a given that all this quote unquote printing, and I don't love that term, but let's just call it printing because it makes sense sort of, is not necessarily going to cause inflation.
Okay, interesting.
So that's where we are on that. And I think it's just important to point that out because that's sort of a common misnomer that we see
I
out
think
there
that's
all
helpful
the
to
time.
dive into because it's kind of what we're taught in kind of basic economics is to expect that, and it hasn't necessarily borne itself out over recent years.
That's right. That's right. And it ignores all the different types of effects too, which is something we should touch on. I think when we have inflation, everybody knows about the pocketbook costs, right? But what about the federal budget? Why don't we talk about that for just a sec?
Absolutely. I think that's also a really important topic to take into consideration when we're talking about inflation. And that's part of the reason why it's really important for Congress to take a strong role in monitoring inflation. The Congressional Budget Office says that inflation does have a very big effect on the federal budget. If CBO says that if inflation is just 1 percentage point higher each year than the baseline expectations, this is about 2% is what CBO is expecting going forward over the 2 years because that's the Federal Reserve's target. That would add $5.2 trillion in more spending above the baseline. $5.2 trillion just from 1 percentage point each year going forward over the next decade. And part of that, about half of that, $2.4 trillion of that would be higher net interest costs, net interest payments that are going to creditors just to carry the load of debt. And the federal government would also see about $2.9 trillion in higher revenues as a result of that inflation and the more activity going on in the higher nominal level of activity going on in the economy. So that's a pretty significant impact of inflation on the economy.
Yeah. And just so the federal budget, we have so much baked in, right? That
exactly.
If we do get the higher price level, we're going to just see an even larger spike in spending.
Exactly.
And what about, and maybe this is just one fine detail to get out there too, the way they account for inflation in those programs. Are there any issues there for people to pay attention to?
Absolutely, and this is a really important thing for members of Congress or policymakers that are concerned about the potential impacts of inflation should be really focused on. Is that the federal government for our spending programs uses an older and outdated measure of inflation. It uses the basic CPI, the Consumer Price Index, whereas the federal government has developed newer and more accurate measures of inflation. The chain CPI is considered more accurate because it takes into account consumer behavior and the replacement effect for measuring inflation. The Federal Reserve uses PCE, the Personal Consumption Expenditure Measure, which is also considered to be more accurate. In 2017, we updated the tax code to use chain CPI in the tax code, and it's considered to be more accurate. So there's no reason for us to use an old, outdated measure of inflation for our spending programs. Yeah. We can ensure that people get more accurate cost of living increases by just updating the measure.
Just using a better measure.
Absolutely. And so that's a really important thing if you're concerned about the potential impacts of inflation on the economy, on the federal budget. Let's just measure it. Use the more accurate measure that we already have, that the federal government already produces.
Makes sense.
Absolutely. So we've talked a little bit about the fiscal impacts and the fiscal considerations. Let's spend some time talking about the Federal Reserve, right? So I know one of your favorite issues, right? So for the last more than a decade, the Federal Reserve has been operating under a financial crisis framework, even though conditions on the ground have certainly changed since 2008, right?
Right.
But can you talk about how the Federal Reserve might have to react to inflationary pressures?
Yes.
Given this framework that it's operating under?
Sure. I think this is one of the big underrated, sort of under the radar kind of things, that people don't quite get. We just don't talk about it enough because it's so esoteric. But after the financial crisis, the Fed sort of backed into, out of necessity because of what they did, this new operating framework. And that new operating framework hinges on paying interest on reserves. Okay.
Okay, what does that mean?
And that means that when they buy a whole bunch of stuff, assets to put liquidity into the economy, they create reserves. And then, whereas previously they wouldn't pay any interest to the banks that were holding those reserves, now they do pay interest to the banks in order to get them to hold those reserves. Okay. So instead of relying on lending, interbank lending of reserves, which is the federal funds market, everybody knows about the federal funds rate. Well, instead of doing any of that, even though they still talk about it, the primary control mechanism is interest on reserves. So they create a bunch of reserves by purchasing assets, whether it's mortgage-backed securities or treasuries, and then the bank reserves pile up. If those get used and lent out, that is inflationary. So in order to prevent that, they start paying interest. The Fed pays interest to the institutions that are holding those reserves because that's what will keep it in check, right? Well, that's fine in theory, but this is entirely new.
Yeah.
And as the Fed has continued to do this, rather than revert back to their pre-crisis system, their balance sheet has continued to grow. And sure enough, they didn't normalize enough in time before the next crisis, and now the balance sheet has grown even more. So what is going to happen if we have higher inflation is that we're going to be in a completely untested environment as far as how the Fed operates. But what we do know is that they're going to have to pay more interest to keep those reserves from getting out there to fight inflation. Yeah. Right. So we could easily be in a situation where the Fed is paying hundreds of billions of dollars a year to large financial institutions in order to keep inflation in check. That's a political problem, and we don't know how well it's going to work because we've never really done it before. So that is an enormous risk. There's a lot of unknowns there, and there's a lot of obvious problems there that, Elizabeth Warren, for example, is not going to like, right? Yeah. But that's the control mechanism that's set up. And if interest rates or inflation expectations start picking up, which is entirely possible, we're going to quickly be in a situation that is 100% new territory.
Wow. So given that, let's talk about what Congress should do. Like, what are some of the long-term reforms that policymakers should be taking into consideration to deal with this paradigm? And
long-term, I think part of the answer is what it was coming out of that last crisis. It's don't just let the Fed do whatever they want. Make them come up with a plan. And it doesn't have to be, we'll clean up and go back to our old operating system next year. It can be, here's a schedule that we're going to follow for the next 5, 10 years, whatever. So you put it out there and everybody knows what to expect. You could do something like that. That's one thing. Another thing is to get rid of this price stability and unemployment. We call it the dual mandate. Mm-hmm. We don't want the Fed targeting prices, and we sure as heck don't want them targeting unemployment. Many Fed officials admit that there's very little that they can do about unemployment.
Really?
So there's no point in worrying about that from the Fed's monetary policy standpoint, right? It maybe is a fiscal issue and a regulatory issue, but it's certainly not the Fed's problem. What we want them to be as neutral and as passive as possible. And one way to do that is to target total nominal spending, mm-hmm. or you might hear NGDP targeting, something like that. That would be a much better approach. It's a single mandate instead of the dual mandate. And then we also want to do is we want to clean up what we have, which is now a blurry line between fiscal and monetary policy. Mm-hmm. Let the Fed do that monetary policy thing. If the federal government, if Congress is going to buy, let's just say, mortgage-backed securities to save Fannie and Freddie and to bolster the securities market, let them do that. Let Congress do that. Let it be transparent.
It'd be a political fiscal debate.
Exactly. Let them have that debate in Congress and let people see who's voting on that, when they're voting on that. Keep that stuff separate, because now what you have is this weird sort of relationship, or, well, I don't know if it's historically, maybe it's not weird, but it's problematic historically, where you have the Fed standing ready to accommodate anything you have on the fiscal side. but without the same accountability, right?
Yeah.
It's just this thing that's in place. And now you have a Fed who can't rely on, their mandate pressure and say, well, we can't just buy all this stuff because it's going to be inflationary. They have an operating system now in place that lets them literally do things without causing inflation because of this new control mechanism that they're trying. But there are real fiscal and political costs to that system, and we don't know how well it's going to work in terms of actually lowering inflation. So Congress or I should say, it should be Congress's responsibility to control monetary policy and to control the Fed, and that's what we need them to do. We need them to stand up and do that and keep their fiscal operations separate.
Great. Well, Norbert, thanks so much. I think that's been a really helpful breakdown, and I think it's been great having this conversation with you here with everybody today.
I think so. I think I've enjoyed it, Matt.
Absolutely.
So thank you all for joining us. We appreciate you tuning in. We hope that the conversation has been informative for you and it informs your work. And you'll receive a survey immediately following the event. Please complete that survey so that we can bring ideas that you care about to the public square again. Again, thank you very much and have a great day.
Great. Thanks, Norbert.
Thanks, Matt.